Welcome everybody, wherever you are, to this event sponsored by the Corporation Society Initiative, CASI at Stanford GSB. My name is Anata Dmati and I'm a faculty director of CASI. We at CASI seek to engage the broader community here and elsewhere on issues around governance in business and in government, which are essential for our market system to deliver on its promise. We want powerful people and institutions to be accountable to society. I'm a professor of finance, and today is about finance and financial markets. What does that have to do with CASI? In our basic finance courses, which I've taught for many years, we assert that the stock price embodies all the great things corporations can do, all the positive net present value projects. Our basic teachings and the models that most academics study assume away the possibility of fraud and do not have hedge fund investors who try to make money finding fraud and betting on price going down when they do find it. But today, we have that counterexample right here. We're so lucky to be able to host Fahmi Quadir, who will explain in further detail why her work is so relevant for CASI. And moderating this event and introducing her further is one of our amazing student leaders, Chris Cobham, who actually is himself from the financial sector and going back to the financial sector. So I'm sure it'll be a fascinating discussion. And thank you all to our leaders. Anna Zimmerman is watching the chat, the Q&A for your questions. And thanks Loretta and the event team at GSB for making this event possible. I'll let Chris take it over from here. Thank you very much.
Thank you, Anat, and good afternoon to everybody joining us here virtually today. Glad to have you all here with us for this very special session. By way of introduction, I am a second-year MBA student here at the Stanford Graduate School of Business, and as Anat mentioned, I myself come from the finance and investing world with 4 years at JP Morgan before the business school and joining BlackRock as an investment professional upon graduation. So without further ado, I am honored to introduce Fahmi Quadir, our guest of honor. Fahmi is the founder of the hedge fund Safkhet Capital, where she focuses on concentrated short positions driven by in-depth investigation of fraud and corporate crimes. For those in the room who may not be familiar with the term, short selling is when an investor, like Fahmi, borrows shares of stock to sell today with the expectation that the stock price will fall and they will be able to buy those shares back at a lower future price, thereby pocketing the difference. The potential losses are theoretically infinite, as there's no limit to how high a stock price can go. And in a bull market like we've had the past decade, stocks mostly tend to go up. So Fahmi is here with us today to shed a light on how she has persevered through such an environment and how her work keeps companies accountable at the end of the day. So Fahmi, we'd love to start off by getting your take on the state of play today. With rising inflation, increasing shocks to the market, geopolitical tension, do you think we're in a materially different spot from last year? What does that mean?
So thank you, Chris, and thank you, Anat, and thank you to the Stanford community and to CASI for hosting me virtually this year. I'm joining you all from London, the latest place that my work has taken me. So it's evening here. And I'm hopeful that maybe next semester I'll be able to join you guys on campus. So to start, I think there's little that's more insufferable than hearing single stock fundamental investors talk economics. So I'll do my best to stay in my lane here. For as long as I've been in the business, I've heard managers very publicly, very boisterously complain about the Fed, about negative interest rates, about quantitative easing, and they've always blamed all of this for their underperformance. At the same time, they've allowed this myth of the Fed put to become totally internalized. It's a part of the collective investment consciousness right now. And this Fed put has been used to justify complete speculation. I think most normal people would call it gambling. These are behaviors that a few years ago, at least from my seat, were things that would be dismissed as day trading, but it's now become accepted investing practice. And we are seeing it, especially in liquid markets, like crypto and like within equities. So this kind of gambling mentality has almost become muscle memory for investors who once upon a time may have considered themselves fundamental investors. So it's going to take a lot for these investors to unlearn some of these bad behaviors. So even if the economic realities that you're talking about, wages, prices, Ukraine, even though we're constantly exposed to these narratives, it's not really sinking in. Rather, sometimes what we see is that the market is often driven by false narratives. And one thing that I started hearing a lot, starting at the end of last year, was that value is king and that growth is dead. Okay, I can understand why people might say this at first, because of course we did see a sell-off in the QQQ, so the top 100 names in the NASDAQ. So we saw a lot of the repricing in some of these growth momentum-driven names. But at the same time, what does value really mean? I believe that markets are generally pretty efficient. So if a company has been trading at a very, like a single digit multiple for many years, I don't know if I would necessarily call that cheap. It's probably garbage. So the thing that we saw during the pandemic were, a lot of businesses that were on their last leg, that were reaching for fraud, for example, to extend their life cycle, suddenly had extra liquidity that was completely unexpected. And over that period, they were able to buy additional time. They would buy additional time to, continue to defraud people, for example. So we saw a lot of, these consumer finance businesses, for example. We like to look at payday lenders. All of them got, a new lease on life because of all this liquidity. But the thing is, these things were always trading below book value. They were always trading as cheap businesses if you look at, multiples. Why is that? It's because these businesses are dependent on screwing over their customer. So over time, the business model blows up, especially when you're, entering a tightening cycle as far as credit. So this is one of the false narratives that I've seen pop up in the past few months, where people are considering only that a business is generating cash, but not the quality of that cash flow, which should be equally as important. But another thing that I'm hearing a lot is that, so-and-so stock is now down 50%. So the bottom is in, buy the dip. So what that tells me is that even though the headlines are showing that we're all a lot more uncertain about what the future looks like, people are still using share price as the ultimate determination, a determining factor for their various investment decisions. Their call on whether a business is going to grow or fail it's again still driven by price, driven by momentum. So while some investors are starting to, get their mojo back, thinking that maybe we're getting back to fundamentals, as someone who's sort of been watching this play out and is hyper exposed to prices that are disconnected from fundamentals, I'd like to say that, as much as I'd like to say that we're getting there, I don't know if we have. We're not there yet. Again, we're trying to, use this false fundamental sprinkling of a narrative on top of something that still hasn't changed, which is, prices being driven by these narratives and sometimes these false narratives. It's driven by sentiment and momentum, not by real analysis. So it's a very, while it seems hopeful, and if you just look at how the portfolio has performed over the last 6 months compared to the past year, obviously things seem like they've gotten better, but it's never really satisfying when things are moving for reasons other than the various pieces of information we've picked out in our analysis.
So it's interesting, Fahmi, that you mentioned this huge focus on narrative over analysis, kind of taking prevalence and determining how people are deciding what to invest in the market today. And I think if you look back to last year, there's maybe no narrative that got more press than the Gamestop saga. So I think one question that's on our audience minds is, what is your understanding of what happened there?
I don't know. I get asked about this a lot. But I think at base, while the media is trying to create like a David Goliath story, or talking about hedge funds taking on excessive leverage, taking on these ridiculous bets, that stuff has always existed. Retail investors have also always existed. They've just become more prevalent, and they become they're more part of our focus as a society in the peak of the bull market, right? Because that's when people start seeing advertisements for crypto during, while they're watching the Super Bowl. And then, grandma might be watching the Super Bowl and saying, I'm not making any money holding my cash in the bank. Why don't I get into those high yield crypto savings accounts? So we're at that point in the cycle where you kind of have this strange tension where clearly things are maybe going to not be as good as they've been, right? We clearly had the pandemic, and that has covered up a lot of bad behavior in some of the businesses that we look like. It provided liquidity to businesses that probably shouldn't have had it. But now we're going to see like what is the consequence of all of that? Have we seen peak growth, at least in the near term? And what does that mean for businesses that were simply not growing, or were simply losing money for the past decade? So as much as it feels as though certain stocks have had these violent moves, in reality, I would say most people are as bullish as ever. And there's like a danger to this, because it's this mentality that this idea that the stock market can never go down 50% or 80%, because it's almost like an apocalyptic sort of situation. People can't fathom the idea that prices may correct and multiples may change. And the way the economy has been growing, it might slow down. It's like we've been trying to delude ourselves into thinking nothing, this time is different. But it's rarely ever different, including these situations like Gamestop and AMC and the rise of the retail trader. It always happens. It's really just, everyone is going to try to enjoy the party while it lasts. But who's going to be the last one to leave?
So I suppose with that focus then on sort of narrative and the rational factors taking a back seat, that tends to drown out sort of the strength of a well-reasoned investment thesis. And I'm wondering then, does that change how you think about the role that you play in the market?
It's really, really difficult. I can't understate how difficult it is. The guys that I went to for advice, that I looked up to when I was starting Safkhet and figuring out, how do I get a short only fund, up and running, those guys are retiring, and not because they're old, but simply because it's intolerable. The losses that short sellers have had to suffer have been intolerable. But it's not just that. It's sort of this cycle where, yes, the losses are bad because the markets are going up, because there's a lot of liquidity, and because fundamentals have become much more disconnected from price. But it's also, that also feeds into the capital allocation cycle, where allocators are looking at short sellers and saying, why am I going to pay to be hedged in this market? I'll just lose money. So there hasn't been much, allocating activity to short focused funds. So that is also has pushed us to the brink of extinction. And it's just, you can only tolerate so much, right? As far as losses, as far as willing to tolerate those losses in the market. So many short sellers have just tried to figure out different ways of doing things. And everyone's heard the phrase, a bull market dies when the last bear capitulates. So I think the statement's a little bit archaic, because maybe in prior market cycles, there were no bears like me who have the pain tolerance to continue doing this, because throughout this entire period, we've remained short only, and we've always remained, exposed to that risk in the market. And yeah, it's certainly not easy. I understand why people don't want to do it, but when the clearing moment happens in the market, whenever that is, whatever that looks like, it's people like me that come to pick up the pieces, because we've already done the work. We understand these businesses, so we can help provide signals for what's the most effective and the safest ways to allocate capital in that new market order, whenever it comes.
So perhaps let's maybe shift gears a little bit, because I think there's another topic that also tends to come up a lot here at Stanford, and that's the increasing importance of private markets as a conduit of capital to the growing companies of today. So you now have this growing space where you don't have the ability to maybe easily bet against these companies. How do you hold them accountable if most of the capital being raised is now in a space where it's not easy to put on a position against them?
So I'm glad I'm not there in person for this question, because I think I would have had some tomatoes thrown at me. But I just like to ask you, do private investors need protecting? Because I would say in most cases, public markets need to be protected from private investor exits. These private equity and VC dudes, they're not stupid. They are stupid rich. So in most cases, in my experience, these investors know exactly whether the technology or idea they're investing in is something that's even remotely plausible. More often than not, they just don't care. They'll happily invest in these non-ideas that are completely fantastical because, well, let's see, they get in these businesses at ridiculous terms. Their investors give them more money to do it, and they'll pay them higher fees. So if you want to keep getting more stupid rich, you need to invest in more and stupider and stupider businesses. Because as long as the equity markets are preaching, buy the dip, look at that TAM, diamond hands, then private equity investors will get their exit. So what we've seen over the past decade is that hedge fund managers are looking at all of this and saying, hey, we can't make money in public markets anymore, so we're going to do that too. And it's just been toxic. It's toxic for public markets because the pension funds, the retail investors who get duped into buying this trash, they're the ones who are holding the bag, but it's also toxic for the businesses themselves. I think a very good example of some of the toxic elements of this is what you see happening in Tel Aviv. It's become now, it's the most expensive city in the world. SoftBank has opened an office there. You have millions that are being thrown at very smart young people who don't have any idea what they're going to build or what they're going to do with that money. And if just ignoring the businesses that might have come public, that might be, sort of fraudy, there are startups that are good ideas, that are run by good people, that deserve a chance at growing their business, that are being prematurely forced to go public through SPACs, because, and oftentimes at absurd valuations that the founders never ever would have imagined and would never accept, except their VC backers are egging them on to do it. So they're now entering public markets when they're totally not prepared for it. So to me, this is literally value destruction. It is not innovation. It's like the opposite side of vulture capitalism, but it's equally damaging. So, how do we solve this problem? Again, it comes down to allocators. Allocators continuously pump money into private equity funds, into venture capital. They hold, they hold the bag, so they should do more to hold these various firms accountable. And that's, I think, the place to start.
So I guess maybe what what follows from that then is, as I guess as a GP who's had conversations with allocators, what question do you think they ought to be asking that they aren't, that would help them maybe figure out who's for real and who's just chasing the latest trend?
Well, they really should be thinking about what is the real thesis behind this investment. Is my manager providing some kind of story that isn't even a solid story, that they're using to, just as like a veneer to cover up what they know is a guaranteed money-making venture? The thing is, with these sorts of like situations, regulators are watching, politicians are watching. Increasingly, private equity, venture capital is no longer the darling, driving innovation, driving Silicon Valley. People are starting to call out the fees, call out the way that they actually measure their performance. They're calling out the effect that they're having on these new developing businesses. So, before something, before someone's hand is forced, allocators should really be more thoughtful and put more pressure on having these firms actually explain what the business is, what is the plan for that business, and what is a realistic exit, so that those businesses will not just collapse after the venture backing has been pulled.
And so I think, kind of branching off of that, there's the allocator angle to look at, and then perhaps the regulator angle as well. And I think one question that's been raised a little bit now is how the recent SEC focus on SPAC accounting and restatements is going to impact some of that behavior. And sort of what's your take on that?
I think, it should have happened sooner. It should have happened sooner, because think about how many SPACs came to market before the SEC came out and said that we need to take a look at the disclosure requirements for these SPACs. We're always slow, to the ball. Fraudsters are always fraudsters and greedy people are always going to be many steps ahead of us. So I would think that, given the scrutiny that the SEC is now focusing upon SPACs, and just the risks involved and the fact that SPACs are wildly underperforming the market right now, I think business founders will give some more thought to just going along with what their VC partners are saying, and they'll probably hold off on trying to come to market through a SPAC. And we are actually seeing this happen more, where these mergers just sort of blow up. So that's a good thing. But the companies that are still pursuing the SPACs are, at this point in the cycle, I think are guaranteed to be garbage for the most part. That's at least from what I've seen.
And I think that's a sentiment that's being echoed in a lot of places where the flow of SPAC capital is all but dried up in more recent months. So I think maybe we can shift gears a little bit, maybe talk about some of the ins and outs of what you do as a short seller. I think one of the biggest challenges that we hear about from the outside is that a lot of the executive teams, management teams who you are interested in hearing from, once they know that you're taking the short position, they know who you are, they don't want to talk to you. How do you get the ear of somebody who's kind of predisposed to see you as the bad guy?
Well, I try first and foremost to operate in a way that is completely unassailable. So if the company's management was to reject me, to look at me in the wrong way, to try and do something, it should, for the most part, make them look unreasonable and make them look guilty. So even if the management itself may view me as their adversary, I have been to events, for example, where the shareholders of the company know who I am and hold me in some regard. So if the company's executives try to be hostile towards me in those in-person events, shareholders have intervened on my behalf, because they understand that I'm not there to cause a scene. I'm not there to create any drama. I'm just there to observe, and I'm there to engage just as any other market participant would. So in general, I have a good track record of being able to sit down with management, because just frankly, it's easier for them to do that, because maybe there's a small chance they can convince me that, everything I'm asking about, I'm just completely misguided. So far hasn't happened, but still they can at least try. But it's interesting because you often hear other short sellers say that they don't speak to management because they don't want to be seduced by the lies. I would like to tell you all that I think that is complete BS, because if there's any, very solidly, consistently, BS detectors in the market, they're short sellers. They're deeply cynical. It's going to be very hard for even the most charismatic of management to ever be convincing them of any sort of lie. So I would think that most of the time, other short sellers say this because they don't get the same opportunity to meet with management, because they operate in a different way. So, they might have a much more public presence. They might be publishing reports. They might be, frequently talking about the company on Twitter and like live tweeting, meeting with management. So, I stay away from all of that because I see the value in actually being able to sit down and have those discussions. If nothing else, if there's nothing informational, it's really about sometimes the softer things and being able to assess behavior in those meetings and establish like a baseline, how stressed is this executive? How much is he sweating in these situations? So I hope that through this, I'm able to just sort of normalize having discussions, for company management to sit down with those who have critical views and probing questions, just as they would, with any analyst who wants to congratulate them on good earnings. It should be just a sign of a healthy market, and the strength, really, of the business itself.
Yeah, I think one of the biggest examples that Anat and I talked about in the lead up to this talk was your work on Wirecard, and sort of how you were able to get inside the tent and figure out what was really going on. So I think it would be great if you could talk about that maybe a little bit. Yeah.
So criticism of Wirecard began the day there was a Wirecard, and it didn't start with short sellers. It started with Wirecard's own shareholders. This was a business that was focused on processing payments in the early days for online pornography. And that's literally all it was. And in some ways, that's literally all it ever was. If there was any legitimate part of Wirecard's business, it was that it processed porn, processed for porn, it processed for, offshore gaming, things like this, the sort of gray market of e-commerce. Wirecard was there. So yes, that was the legitimate piece of Wirecard. But the thing with these types of businesses that are focused on facilitating transactions in the gray market digitally, they're doomed to failure. So by and large, they never go public because they don't want the scrutiny. And they never get very large. And that's just because they are limited by just the economics of the business model. Because the more you have transactions that are in these sketchy areas, the more likely that a consumer will allege fraud. And if there's potential fraud and the bank that issued that credit card agrees with the consumer, then you're on the hook. And then you have to, the fees start to add up. And eventually what happens is you get kicked off the card networks. So this is, in a nutshell, what Wirecard's business was. Yet somehow Wirecard managed to become a $20 billion company. It managed to send those shareholders that asked those probing questions to jail. And it also managed to, time and time again, completely just brush aside short seller allegations And this last round of criticism against Wirecard, it also tried to brush off. So let's go back a few years to 2017. So at this time, in 2017, a lot of things were happening, especially within the payments space. If you don't know already, Wirecard, now people are admitting it, was basically a front for global money laundering. What you see happening in 2017 is that a lot of the business, a lot of that laundering business that was flowing through Wirecard is finding a home in crypto and in digital assets. And we actually see a lot of the individuals that were bringing business to Wirecard now starting, crypto businesses instead. So Wirecard was, fundamentally under pressure because the whole thing was kept alive because they had tremendous volume coming from that money laundering business. So what happens next? Germany decides Wirecard is one of the best companies in our country, so we are going to include them in the DAX. So DAX, you can think of like the German version of a Dow Jones. So it's like the top, most solidly blue chip companies in Germany, and they were going to include Wirecard. At the same time, a whistleblower who worked for Wirecard in Asia came forward with fraud, fake contracts that he saw in Wirecard Asia. And he then took that information and went to the Financial Times, and the Financial Times started publishing on Wirecard. So what was Wirecard's response? Fake news. Financial Times is criminal. It's colluding with short sellers. And what does the German securities regulator say when one of the best financial news outlets decides to publish all of this critical work on this business? The German securities regulator BaFin comes out and says, we're going to investigate the Financial Times for market manipulation. So take it a few months later, what happens next? Wirecard's stock, after it gets in the DAX, the stock price doesn't seem to go up anymore. This is a problem, and it also, the stock price also seems to go down when the Financial Times publishes reports. So what does the German securities regulator decide to do? They say, we're going to ban short selling in Wirecard. So this was just an incredible moment. And I was actually at CASI for the first time within days of this announcement. And it was the first time you've ever seen this in any developed market where a single security that isn't systemically important have short selling banned. It was absolutely insane. So we knew at that point, despite our efforts to get BaFin on board with our analysis, that they weren't going to do anything. So as a short seller, it's really important for us to focus on who is going to care about the information that we have. And our research was focused on money laundering, and money laundering matters to no one more than the United States. So that was our angle. So we dug in deep. We tried to figure out everything Wirecard was doing in the US. We tried to figure out all of the actors involved, who was the kingpin of that business. And we tried to get as much confidence around that information, tie it up neatly in a bow, and give it to authorities so that they could do that, the next steps, which would mean subpoenas. So this eventually led to March 2020, where the kingpin of the US business was arrested. And a German former Wirecard guy was also arrested. And this was, again, before anyone really knew what was happening, because no one was following the US and what was happening here. But Wirecard's co-founder, the supposed Russian agent, Jan Marsalek, he was, of course, following what was happening. And this US guy who was arrested was his best friend. So it was the second week of March. It was at Jan Marsalek's 40th birthday party. He had a complete mental breakdown. He drank 2 bottles of vodka, was by himself, was rolling around the ground, crying, mumbling to himself, and 2 months later, Wirecard, of course, collapsed because that man, Jan Marsalek, was gone. $2 billion were gone. And c'est la vie. I had just covered my Wirecard, my last few shares that I had short. It was about 2 weeks ago because it was finally delisted officially. So I'm no longer in the trade.
Oh, I mean, I guess that's a phase where the book is finally closed on the Wirecard trade. I know that you put out a paper on your funds on your firm's website, basically explaining, your response to BaFin's decision and sort of an argument for your role as the short seller in keeping the market honest. And I think I'm kind of curious, what was BaFin's response to that paper? Were they receptive to your argument?
Well, they didn't ignore me. Before I published the letter, of course, I gave BaFin a chance to respond to me and sit down with me. And, what did they say? They said no. They said no. They didn't ignore my emails. They didn't ignore my letter. They read my letter, but they said no. I reached out to them again after that. I have information. I have analysis that I feel you should know about Wirecard. And they were like, no, not interested. I was in Frankfurt speaking at a legal conference, and I was outside of BaFin's offices. I called them. I said, I'm here. I'm outside your door. Can we meet? And they said no. So they, just like I said, I had this information that I tied up, put it on a silver platter, tied it up in a bow. They were not interested. So we had to find authorities that were interested in that information.
So you kind of have yourself in this position where you really have to go over their heads for somebody to start paying attention to it.
Yeah, and I never want to do that. It's a German company, right? They are the domestic regulator. I don't like to, like I said, I don't like to create drama. So I didn't want this to happen. I gave them every chance in the world, but it wasn't even like I wasn't getting through to them. It's just that they were just saying no. They wanted nothing to do with me.
And, perhaps it's an issue of alignment of interest. If it's your country's darling company that's driving your stock market, you maybe don't want to be the person who allows people to put in bets against them.
Well, yeah, because Germany is it's an industrial manufacturing type of economy. So this was a technology company, or at least it was able to go around parading itself as so. So it was within German interest to, of course, promote that, even if they didn't necessarily know the criminal extent of the behaviors. That said, there's perhaps, between the US and Germany, there's a misalignment of geopolitical interests here, because the US, of course, is a lot more interested in money laundering. They're a lot more interested in going, up against these sanctions on Russian oligarchs. That is something that is a geopolitical interest for us, also because we are the world's fiat currency. So we do need to worry about the integrity of the dollar and of US financial system. So money laundering is a big deal for us. Germany, it's a dime a dozen how many money laundering scandals happen there. And I don't think this means that, we can just say Germany is a money laundering haven, but it's just not a priority for them nationally, just as much as trying to diversify their economy maybe.
And it's interesting, if you fast forward to today and we look at what's going on in Ukraine with the crisis with Russia, one of the potential, penalties that has been talked about is limiting or cutting off access to the SWIFT system. And so there are rumblings that Russia and China are looking to create an international payment system. What does that do if suddenly you have a section of global economy that is cut off from US control and influence? That's sort of a check and balance that's removed.
Well, it's so interesting that we're at this moment, because Olaf Scholz, the new chancellor of Germany, was in charge of overseeing financial regulations under Merkel. And that was during the Wirecard scandal. So he was in charge of overseeing BaFin during that whole period. And that isn't to say that he was guilty of anything, but it is just a severe lack of oversight. So I think that's all. It's all very interesting to see how this has all been playing out politically. But can we already have an economy that exists outside of the financial market that the US oversees and regulates, right? It's the thing is, these criminals, organized crime, have found a way to make that market bigger and more liquid and more convenient for them through innovation. And the government, just as it is with most things, is very slow on the innovation side. And as it's going to be a really hard game of catching up now to all of these new innovations in DeFi, Web3, all of these things, while it's like these criminals are printing money. That's effectively what it is. So rogue states, more oppressive regimes, they might see a benefit in aligning themselves with these criminal interests because it suits some of their own national priorities, right? So it's going to be difficult, but I think we need to act sooner rather than later. And that this isn't to say that we cut them out of SWIFT. I think it's probably more difficult and not as practical of a thing. I'm not sure how it would work, but just thinking about where is the dark money, how is that currently existing, what that economy, how do we do a better job of regulating it, or at least integrating our own economic system, our own financial systems in a more cohesive sort of way.
Right. I guess it's how do we get a handle on these flows of payments where, as with many other things, technology seems to move a mile a minute and government and regulation can hardly keep up with the pace of change.
Yeah, but human beings are also prone to failure. I'm sure everyone has, read about the great Bitcoin heist. How did they eventually get caught? It was because they put money onto a prepaid card. And that's also kind of, what led us to Wirecard. Because eventually you need to be able to use cash. And prepaid cards have they're very old school, but they're also still very convenient. But these are little things. Prepaid cards are not a new innovation. And ultimately, people who are, needing to have clean money, they sometimes want actual cash. So if they need to use a prepaid card for that, then, maybe we need to start thinking about why do we have prepaid cards in the first place?
Right, exactly. So I think as we're thinking about situations like Wirecard, you've got a couple different players who are expected to sort of keep everybody honest. You've got the government, you've got the investors such as yourself who are looking at the company and trying to ferret out what's going wrong. And of course, you've got, the auditors who are supposed to vet the financial statements for accuracy. I think one question that kind of pops up as we look at the situation is, why wouldn't the auditors have identified these items perhaps before short sellers would have caught on to them, given that they were essentially responsible for ensuring these were accurately presented?
This is this Wirecard, I think it is a unique situation. It is a very clear example of what we would call an overly cozy relationship between the auditing partners and their client here, Wirecard in this case. So it became when you're auditing someone for such a long period of time, you start asking fewer and fewer questions, or you take certain things at face value. So I think we have to consider, what is the right period of time that an auditor should be auditing a particular business, and balancing, their expertise and familiarity with the financial statements, but also, with the fact that they are so closely working with the same client for many years. So that's one issue. But, we can't just depend on one piece, one stakeholder within this ecosystem to find everything, because auditors can get screwed over too. Because when we're talking about frauds, when we're talking about criminal businesses, criminal management, sociopathic management, they're going to lie and say whatever they need to, create whatever fake documentation that they need to defraud the auditors as well. So we can't forget that piece. So there needs to be multiple checks and balances here, because it's not as though short sellers are the first line of defense in fraud. We're basically like one of the last lines of defense against fraud. So yeah, I can't just put all the blame on the auditors. And at the end of the day, auditors are hired by the company itself, and they're not there to find fraud. They're there to just ensure all the boxes are checked, that the books are balanced. And that's really the crux of their job. What I don't think auditors maybe they could perhaps spend more time assessing some of the like softer features and more governance related features within a business, like tone at the top. I think it's really important to understand the culture of the place, because fraud doesn't occur in a vacuum. There's usually opportunities, incentives that exist there for someone to potentially put their livelihood on the line to commit fraud that will enrich the business. So yeah, I think there are small things that can be done, but even still, it'll never end with just the auditors. I think every piece of this is equally important.
And I think that tone from the top piece is really one that does or ought to resonate heavily with the people on this call who are from the Stanford Business School and other business school classes, who may well be going on to these sorts of leadership positions at some point in our career, and will be in the position to set that sort of a tone. And basically, it's that the trouble begins long before it gets to deciding which numbers to adjust or which figures to fudge. It really starts with how people think about right and wrong within the culture of the company, it sounds like.
Yes, exactly. And sometimes it's just as practical as like, what can you get away with? Because not everyone is going to have the most sterling moral compass. So with Wirecard, for example, they were literally taking plastic bags full of cash to and from Wirecard headquarters, right? And Wirecard employees, everyone, this is in full, plain sight, right? So if I'm some middle manager in Asia and I hear that this is going on, then, I realize that I can be as aggressive as possible, and I'll still have a job, and I'll actually be rewarded by the business.
Oh my God, it sounds like something out of a movie when you describe it that way. Like it's like a scene from Wolf of Wall Street. I don't know.
It's worse. It's even worse.
So I think, as we're getting down to some of our final questions here, I think one other item that comes up from our audience, within the GameStop saga of last year, and sort of this narrative driven short selling and short squeezing, Melvin Capital almost went under because of their short position on GameStop. And I think there was another fund that made money on the opposite side of that trade going long. And I think that the question that comes up a lot from retail investors and people who are kind of watching the market is, might there have been any sort of manipulation that had been going on? Are there bad actors perhaps who are getting involved in the midst of all of this?
There are bad actors everywhere. There are bad actors regardless of market conditions. And I think just the difficulty of generating alpha in these markets have probably forced some managers who previously were not overly aggressive or taking excessive leverage or engaged in any kind of dubious market activity. Perhaps they felt the pressure to, just because it's so hard to prove yourself to your investors, or it's hard to keep your track record going, because once you start making a lot of money, people are going to continually expect you to. Whether around GameStop there was manipulation, I mean, it's beyond my expertise. I have no idea. As a portfolio manager, would I ever put myself in a position where in a single stock bet, long or short, my business can go under? I would never do that. But that's me. And I'm a short seller with a perverse relationship with risk. And I'm saying this. So yeah, I don't understand why a PM would let their book get to that point. But things happen, funds blow up, people move on. It's not necessarily a conspiracy. It's the jungle. This is how it goes.
It's just the nature of playing the game, so to speak.
Well, and that's the thing. This market has been all about playing games and not about thinking.
So I think as we're sort of getting down to the end of our time here, I think I'm just kind of curious to hear a little bit more about what it's like to be Fahmi Quadir, and sort of what does the best day in your life look like, and maybe what does the worst day look like?
Yeah, the best days are, the ones where that nagging question that I have, that I've been obsessing over for like a year, I'm finally able to answer it, however that may be. And those days are only rivaled by the days when, I finally see my thesis materializing before me. When a company comes out during their earnings and totally kitchen sinks it. And when authorities come out and say that they've made arrests of key figures that I suspected were engaged in criminal activity, or it's when the FTC sends a cease and desist order to a business that we believe was preying on consumers. So when things like that happen, those are the most satisfying. Those are the most rewarding days. The worst days are days like this one, believe it or not. It's just days where the markets are bleeding, where the markets sell off broadly, violently, because they make my job as a PM very difficult, because I can't rely on my trusted toolkit. I can't just look at my thesis. I can't look at my information, my analysis, my research. I have to start making decisions based on things that to me feel more speculative. So basically, how much further down can something go? And how much risk am I willing to leave on the table? So every day, I think that I incrementally get better at this, and there's no better test than the market we've been in. But it's really hard as someone who's so research driven. If fundamental factors remain unchanged, justifying why I should change my positioning, it's very difficult.
So how does a day like that typically unfold? What's going through your head?
I guess I do talks to Cassie, because I feel like every time I've done a Cassie talk, it's been a bleeding day in the markets. So yeah, I don't try to get too reflexive. I just take a step back, focus on my research, and get a good night's rest, and then decide what I'm going to do the next day. No one's going to die.
What about some of these things like this New York Times article that came out recently, where I think you mentioned that I think your printer turned on one night and started printing out whistleblower letters just on its own without any input from you, and it was almost like somebody had hacked in and they knew how to get at you.
Yeah, we deal with this kind of stuff all the time. It's like a running joke. Whenever something bad happens, we will attribute it to like Wirecard or some other criminal interest that we might be on the wrong side of. But you get used to it. I think in some ways I've learned to embrace it, because it's probably validation that we're on the right track with whatever we're doing. So it never gives me pause. When I got into this business, of course I knew it was going to be a dangerous business. Did I know how dangerous it could get? Absolutely not. But one of the main learnings is that you can never be paranoid enough. So I'm always cautious. I'm always observant. but now I'm in London, right? There was a time when I was nervous, maybe I couldn't do this kind of work in London, but now I'm all in. So I think here, London is one of those places, parts of the city are basically owned by Russian oligarchs. It's a very interesting experience. So I find it, it's an adrenaline rush to be in the lion's den.
I mean, do you feel like London is sort of the best place to be in, to have, a bird's eye view across all the global markets, rather than, the US centric, perhaps, that you might get in New York?
Yes, exactly. You're basically smack dab in the middle. And it's a gateway, right? For all of the money laundering activity, London is the gateway to the United States. And I think that it's really fascinating to see play out, because in some ways, how Miami could be considered the gateway for Latin America to get to the US. London is the same for, all of Europe, and also Asia. So it's a really great place to be. This is the birthplace of a lot of fintech businesses. So, I get to see it all happen firsthand.
So I think we've got a couple minutes left here. And I think, I think what could be interesting to talk about is there anything that you're seeing lately that perhaps you're not getting asked about as much as you wish that you were?
About anything. Honestly, people don't really seem very concerned whether or not there's actually deep levels of fraud and criminality at any business. That's the thing, very broadly, no one wants to get in the weeds. No one wants the expert view. Everyone wants like the one-liner. They want very superficial analysis, very, one-dimensional analysis. No one really wants to hear about, all the work that goes into the businesses that we're researching. I think mostly because they don't care. And people will only care after sentiment in the market shifts. And we haven't gotten to that point yet.
I mean, do you think that's going to change in a year's time, perhaps, if things get tougher, or is this just how things are set to be? Is it just human nature?
Yeah, I mean, cycles will play out as they play out. And some people will get lucky in calling it the right way. I think we all know how this ends. I have no idea when that happens, but it doesn't really matter for the strategy, because we're just always short. We're always mostly 100% short the markets, through the various companies that we're betting against. So whether there's mass calamity, market apocalypse, whatever it may be, we are just here being patient, continuing to do the old school, old-fashioned kind of work that we've always been doing.
It's true. There's true scuttlebutt diligence and really digging in.
Exactly.
I want to thank you so much for joining us, Fahmi, and for everybody who has been on the line with us, and hope everyone has a great rest of their day.